These are my notes from the 2009 Berkshire Hathaway meeting. Okay, the first one, we don't pay any attention to ratings given to a stock because we don't outsource our evaluations of a company, except only to see if a stock has been unfairly underrated, which might affect its price or value, said Warren. Then he said later, know that the market is there to serve you, not instruct you. Also, you have to have emotional stability. Not much IQ is required. You only need to be able to evaluate a few companies, not many. It's better to have an IQ that's 130 that you think is 120 than to have an IQ that's 160 that you think is 170, said Charlie Munger. Max Planck said that bright people resist new ideas. Then Warren said, science advances one funeral at a time. Someone asked Warren a question, and this was the question. If you had 10 stocks and 5 of them doubled in a short time period, would it make sense to actively manage them and take profits in the 5 that had doubled and redeploy the proceeds into your positions that had not moved higher, where presumably more upside exists and the odds are more dramatically stacked in your favor? Or would you favor the strategy of sitting on your hands in the name of long-term investing? Warren's answer, we would own the half a dozen or so of stocks we like best, and it wouldn't have anything to do with what our cost of them was. It would only have to do with our evaluation of their price versus value. And it doesn't make any difference what the cost is. And incidentally, if they went down 50%, we would say the same thing. We never worried about whether something was up or down. We worried about whether it was worth what it was selling for. The best period I've ever seen for buying was in 1974, when you could find PE ratios of 4. But of course, interest rates were much higher then. If prices drop by 50%, I'm happy about buying more. I don't think about the price I paid yesterday just because it was higher. Just like going to McDonald's and seeing hamburgers at a discount, said Warren. Charlie said, if stocks fall 40% on average to what they were before, then of course they're much closer to an attractive price. 1973 and 74 was a once-in-a-lifetime opportunity, but I didn't have much cash then. If I were you, I wouldn't sit around waiting for that to come again. Here's an interesting quote on picking prices, not bottoms. No, we don't try to pick bottoms, said Warren. To sit around and not do something that's sensible because you think there will be something even more attractive, that's just not our approach. Anytime you get a chance to do something that makes sense, we do it. And if it makes even more sense the next day, if we've got money, we may do more. And if we don't, then, what can we do about it? So picking bottoms is not our game. Pricing is our game, and that's not so difficult. Picking bottoms, I think, is probably impossible. When you start getting a lot for your money, you buy it. The best businesses are the ones that don't require much capital. Next is from the 2010 Berkshire meeting. On watching prices go up or down, if you buy a farm or an apartment, do you look at the quote next month? No, you look at the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. But they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more. If you can't get yourself in that mental attitude, you're going to be scared when everyone else is scared, and expect somebody else to tell you when to buy and therefore get your courage back up or something, and a week later someone else will tell him the world is coming to an end and he'll sell, said Warren. I mean, he's a broker's friend, but he's not going to make a lot of money. In the end, what counts is buying a good business at a decent price and then forgetting about it for a long time. Some people can do it and some can't. 6 or 7 years ago, when I was looking at Korean stocks, I never had any idea that Korean stocks would be something that I would be buying, but I looked over there and I could see that there were a number of businesses that met the margin of safety test. And there I diversified because I didn't know that much about any specific one, but I knew that a package of 20 was going to work out very well, even if a crook might run one of them, and a couple might run into competition that I didn't anticipate because they were so cheap. And that was sort of the old Graham approach. You will find opportunities from time to time, and the beauty of it is you won't have to find very many of them. Charlie Munger said, "What was working? What was failing? Why was it working? Why was it failing?" If you have that temperament, you are gradually going to learn. And if you don't have that temperament, I can't help you. Buffett said, "It's avoiding the dumb things. You really don't have to be brilliant, but you have to avoid the almost seemingly obvious mistakes." Okay, this next part is about the best business for return on capital. The best businesses are the ones that need no or little capital, like Fortune Magazine, Sports Illustrated, etc. See's Candy also needs very little. Generally, the great consumer businesses need relatively little capital. The businesses where people pay you in advance, magazine subscriptions being a case, insurance being a case, you're using your customers' capital. We like those kind of businesses, but of course so does the rest of the world, so it can become very competitive in buying them. Someone asked the question, "I'm looking for your fundamental or unified theory of management and life or fundamental guiding principles." Warren answered, "In 10 words or less." "Let me try that one, Warren," said Charlie. "It's pragmatism. Partly we do things in our different ways because it suits us. It suits our temperaments and our natures. And partly we do it because we found through experience that it works better. It's just that simple. And we've had enough good sense that when something is working well to keep doing it. So I'd say we're demonstrating what might be called the fundamental algorithm of life. Repeat what works." Next is from the 2011 Berkshire Hathaway meeting. Goodwill should not be used in evaluating the fundamental attractiveness of a business. There you should look at return on tangible assets, and even then there's some other adjustments you want to make. But basically, in evaluating the businesses we own in terms of what the management are doing and what the underlying economics of the businesses are, forget about goodwill. The advantage to buying cyclical businesses is that a lot of people don't like them because the earnings come in all lumpy at different times. What difference does it make to us as long as the earnings average out over the year? What do we care if it's lumpy as long as it's a good business?